All right, so with today's video, it's a little longer than normal. Brandon, as probably has told you before, he's not going to be here tomorrow. He's out for the rest of the week, going into next week. So you're going to hear from me again on Friday, but no market outlook tomorrow. So today's video is kind of a two-in-one. You get a little bit of you get today's and tomorrow's video today. So a little longer than normal, but that's the reason why it'll be posted here for a couple of days. I'll remind everybody about that tomorrow, unless something crazy happens tomorrow and you'll see me come up. But, you know, we had quite the event today and it created some volatility. So I'm going to break down what happened, how things look going in, how things look going out, some extreme patterns that we're seeing and what they mean, and how to reconcile the trend with these extreme patterns from a trading perspective. So we're going to break that down today. And our trade idea of the day is a stock that's in a sector that's been doing very, very well and has had its own little exhale here in the last little bit and appears to have found some support today with a little bit of a reversal pattern. So we'll talk about how to trade that. So let's go ahead and get started. Today is Wednesday, March the 17th, 2021. This is the market outlook from marketscholars.com. My name is David Settle. All right, well, let's take a look at the S&P 500 first with the market forecast indicator as always. You can see the rally off of the low that we had today, what it looks like on this calendar. We actually started with a gap down. You can see from yesterday's close here to today's open, and then finished up higher again. Got a new high, another day of new highs here. So you can see we are moving this, have to move this line up now from Monday's to today's high. So nice good rally, well off of the 23%. Remember, any move between the top line, which is the 0% line, today's high, and the 23% line, any move is noise. It's just considered noise. So, you know, to kind of put that in some perspective here, for people who get so worked up about even today's intraday move to the downside, when you look at that, you know, that is roughly up at the top left corner about a 4.5% drop. We can have a 4.5% drop from today's high and still just be considered noise. We don't get a pullback until we're well beyond that 3,800 level. So put that in some perspective. The Dow Jones Industrial Average and the Russell looking really good. As always, too, very strong intermediate posture. Near-term line dropping on the Russell 2000 down below the low points. So near-term rally was over with and now potentially starting a new one. Not the case on the S&P. The S&P's near-term line just barely dropped below 80. Didn't really get above 80 for very long. This near-term rally, which is typically 7 to 12 days, has now gone on for 1, 2, 3, 4, 5, 6, 7, 8, 9 days. So a 9-day run. We'll see how much longer that near-term rally lasts before we pull back into some kind of retracement area off of this low point here up to, excuse me, I guess we'd have to draw the retracement, off of this low point here all the way up to the high point. So probably coming down to the 38% would be the maximum on any kind of near-term decline, because that would just barely be getting below the 38% retracement level. Now the nice thing we saw today on the NASDAQ, we did not get above the moving average yet. We're still below a falling moving average. The intermediate line did cross above 50, so we do have dark green shading again. We did slightly close above the 23% level. Now, that's still a smaller close than the last two times, and both those times actually came well, you know, before, like, yeah, they came before here. It was during this pullback. We got to the 38% there, closed above the 23%, opened up below it, closed back above it, finally closed below it over here and stayed down for a couple of days, got back above it, and then we've been down ever since. Well, today we've closed back above it, again, lower than either one of these two. And the last two times we've closed above this line after the drop, the last two times we closed above it, we've immediately come back down. So that's a very important inflection point for the NASDAQ 100 going into tomorrow, because either we break out and we look like this, back to dark green shading and a green line, like on the S&P for the NASDAQ, or we turn back around and stay down and make a run back towards, kind of like what we saw, and I mentioned to you before, on the Euro US dollar, right? This little dollar rally that we had. We got up to it over here, barely got back above it. In this case, actually got a long upper shadow to go along with that slight close above the 23%. And then, boom, we got back down to 38. and beyond. Actually fell all the way to the 62, and now rallying back up to this 23% level of the longer term run, trying to get back above that and seeing if we can get going again from a market sentiment standpoint, because you can see the market sentiment line has fallen below 50. So we've had a long enough of a pullback here in the euro, and so rallying the dollar, that we can consider this a market sentiment pullback. So market sentiment rally is multiple intermediate rallies. So there's one, there's two, right? So we've come down now from that low to that high. We've come down now to beyond the 23% retracement. And as of right now, we're holding that, and we never did touch that 38% yet. So we'll see if we end up holding this again. This again, very important inflection point for risk appetite as a whole, right? As a whole here, you can see, risk. When you look at the dollar and stocks and everything else in conjunction with each other. So that's what we're seeing. Again, from everything else, still very strong on the Russell, very strong on the S&P. Dark pink shading, green lines all across the board here. So very looking very good, at least on this particular indicator. All right, so now before I show you what these other indicators look like on the S&P, I invite you to subscribe to our YouTube channel here. Mouse over this icon, click that red subscribe button that pops out. There's also a subscribe button down below the video if you're watching us on YouTube. That notifies you when our videos are posted. Also, while you're down there, click that thumbs up icon. That lets us know that you liked our video today and that you want us to do another video again tomorrow. It's a quick way to give us feedback. If you don't like our videos, of course, you don't have to click on anything. You don't even have to watch. But if you do like our videos and you want to let us know, click that thumbs up icon. You can do that even right now while you're watching. That's a big deal for us, as it gives us, that's pretty much our survey as to whether you like our videos or not. Also, comment on our video down there. What stood out to you? What questions or comments do you have about anything I talked about in the video today? Join our website and our community at marketscholars.com. There's a link popping out up there in the top right corner of your screen. Click on that link to subscribe to our site for free. You actually get access to our community, to our Market Outlook forum in our community on our website with our free access subscription. Follow me on Twitter for more content in between the videos from day to day. There's my handle right there at DavidSettle42. And join our Market Outlook Facebook group that we've created. If you're watching us on our blog over here, come check out some of these things we have on the right, including our trading rooms. You can see you have access to our trading rooms. You also have access to our Market Outlook lives. Every day I do the Market Outlook. I also do a live video on YouTube at 3:30 Eastern Time. I review all the current Market Outlook trades that we've done in previous videos that we still are in. I continue to manage them up to the time that we close them. I talk about how I'm doing that in these videos right here. So if that's something that interests you, check that out there. Again, all of our paid subscribers get access to our trading rooms and our Market Outlook lives, both our monthly subscribers as well as our premium. Our premium subscribers obviously get a lot more, including access to our class forums and other tools. You can see all the list here. That's why most of our subscribers are premium subscribers. But again, both of these get access to all of our trading rooms and all of our Market Outlook live videos. Come down here, hit this heart. It opens up a new tab. Hit this like button right there. Hit this thumbs up icon, opens up another new tab. Hit that like button as well. Again, the more you do that, the more people will see our content that follow us. That's how the algorithms work. The more likes and retweets and shares that these have, engagements, the more their Twitter and Facebook promote our content to not just to anybody actually, but to our followers, the people actually follow our accounts. It also benefits you because, same thing, Twitter and Facebook will promote content in your timelines from the accounts that you engage with the most. So we try to make it really easy for you to engage with us right here. All right, now let's get back to the charts here, and let's take a look at some of these other charts. If you take a look at the S&P, again, just to keep in mind about this move that we're getting, especially in the Russell 2000, where it's this extreme here. I want to share with you just how bullish we are. From all the way back that we can go on the Russell 2000, right? We are in the 98th percentile on the Russell 2000 in terms of how far up above the 50-day moving average is above the 200-day moving average. 17%, almost 20%. We've never seen that before. In March of 2000, when things were peaking, we were at about 12%. So that kind of shows you just how bullish we are here. That's an extreme level. And this is hardly the biggest low point we've ever seen, right? That low point, that peak came after a similar low point in August and October of 2000 or 1998. The 2003 low point, bear market low point, 2002, where ultimately culminated in 2002, or in three, but the worst was in 2002. That was a similar low point, and we got to a rally of about 10+% off of that low. Obviously, our bear market low point was 20% down, and we got up to about 10%, a little bit above 10% rally coming off of that. So this is hardly unprecedented in terms of the low point we're coming off of when you measure it by this measure, but the rally off of it is unprecedented. That is one of the biggest moves to a peak, right? Not from a total, because you can see some of these are about, that one went from -20 up to +10, so about 30 points. This one's gone about 30 points, just under. So very similar move from low to high as we got there, just to a much, much higher high than what we've seen. So very, very strong move. I mentioned to you before that today was the day that the rate of change, because of March 18th, the rate of change was going to hit its highest level ever. Obviously, on a quarterly basis, it's not there, but I'm talking about on an annual basis here. When you look at this, and we have hit 125%. The Russell 2000, because of the rally today, is up 125% off of that low point right there, the March 18th low point. That is a tremendous move that I don't know if we'll ever get again, right? Again, the highest before that was back here, coming off of the 2009 low. We got up to 95%. That coming off of that March 2009 low, as bad as that was there on March 9th of 09, a year later we were up 95%. We are up 125% off of the COVID low point. That is tremendous. It's absolutely tremendous. Again, you go out to linear regression and you say, okay, well, how bullish has a Russell been on a linear regression standpoint? You go out 5 years, you're near the 2 standard deviation mark. You go out 10 years, and go to a weekly chart here, and you're at the 2 standard deviation mark. You go out 20 years, you're above the 2 standard deviation mark, almost at the 3 standard deviation. So needless to say, the Russell 2000 as it stands is extremely bullish. So when you are looking at how bullish we are now, thinking, oh, there's our correction, right? Because a lot of people have actually termed that a correction. Erroneously, but you got to sell something on TV, right? You're trying to sell ads, and you're trying to get people on that will sell ads, and so some people have actually termed this a correction, especially in the Russell, have termed this a correction. Again, no dark pink shading, right? I mean, let me give you some context on what corrections look like, right? Dark pink shading and red lines. So no dark pink shading. 1 day of a red line. That's it. And the correction actually comes with both. That was about as short as one as we can get. But no dark pink shading. Only 1 day of red line, and we're back up. So this has hardly been a correction. We are still bullish, right, from what we've been on. And in our class portfolios, boy howdy, have we taken advantage of that, right? So, I'm hardly trying to say, hey, stop doing any bullish trades and load up on puts. Hardly at all. But you notice that I am not just in bullish trades, at least for those market scholars that attend our trading rooms. I'm hardly just in bullish trades, but that doesn't mean I'm not making any, and doesn't mean that we're not making some pretty dang good returns on some of them that in fact, one of them we just barely did in our last market outlook video. Just 2 days later is already doing pretty well. So that's not the point. And I know we live in a black and white world where either you're really bullish or you're really bearish. And so if I'm not really bullish, that means I must be a perma bear or really bearish, and that is not the point. The point is that we are very mature in a bullish trend. But a mature bullish trend can last another month or two. For all we know, we just know that the longer it goes, then the bigger the gap will be between the 0 and 23% level. And in this case, there's your gap to this. I have to actually move this higher because we keep 2 days later, we've got a new high here. Actually, it's over there. And let me get this one up to. So there's our highs. And so the gap between this zero and that 23% is pretty big, right? A couple hundred points. In fact, if I showed you before on the S&P was about 4.5%. Well, here on the Russell, we're looking at about looks like a 10% drop on the Russell. 9.5 would just be noise, right? So I don't know if it'd be noise to a lot of you who may have been trying to get really bullish in this area, but the reality is it would just be noise on an intermediate pullback basis. So kind of a noise on a long-term level, we could drop all the way down to here, to where the 38% retracement is of this rally and the 23% level of the long-term move, right? Coming off the COVID low point. This is just the black lines are coming off of the September 24th low. The orange lines are coming off of the COVID low, right? So multiple intermediate runs. So we can come down on a long-term basis. We could have a 14, almost 15% drop and still just be noise. It would be an intermediate pullback, but on a long-term level, it'd be noise, right? It'd be no big deal. And again, I think we're actually going to end up coming down into this area, the 38%, once we actually do start to exhale, which again would just be a pullback to support, no big deal at all, but it would be a 22% drop, and there would probably be blood in the streets and wailing and gnashing of teeth, and the reality is it would just be a exhale. The inhale was so big and so long that the exhales are going to be deeper than what you might be comfortable with, right? I mean, that inhale on a long-term basis is so big and so long, 125% on an annual basis, with 2 standard deviations away from the linear regression on all these long-term levels, with the PPO as high as it's ever been. That's just the nature of the beast, right? And you look at something like, especially when I look at the weekly charts for these directional moves. So let's go to a weekly chart. Let's go 10 years on a weekly. I mean, look at the ADX on the weekly chart. I mean, again, you have to really go back a ways. We'll go as far back as we can to see on a positive basis a directional move that was bigger than this. The only one is back here in 97, going into that 98 weakness, right, where we had a lot of weakness there. That was the only one, right? Every other time it's been, that's a very, very high ADX, or very high ADX, yes, for a bullish move. In fact, it is equivalent to the bearish move that we got, right there, coming down the COVID low. And but even if the positive index didn't get that high as a negative, and it's equivalent also to the bearish move that we had in the fourth quarter of 2018 from an ADX standpoint, right? The ADX got up to the 40. So needless to say, we've had a pretty significant run here, very mature run. You look at the RSI and the CCI again on a weekly chart, not just the daily, but on a weekly chart here. So hit OK on that, and then hit the Russell 2000, and you say, okay, we've been above 70 for quite a while, and again, go back as far as you can on this to see, other periods where we've been above 70 for this long. Again, coming off of bear market low, going into that 2000 peak, going into that 98 period. This would be the end of 97, but there's your weakness in 98. Those we've seen levels of this bullishness this high before. And you can see the CCI has been really diverging, right? Most of the strength came really early, and we've been diverging ever since. That's the nature. So if you think that the correction is over and now we're about to start a new long-term run from today or from the last few days going forward, then we probably need to learn how to manage risk appropriately. Again, doesn't mean we can't make bullish trades. It just means, the return to the upside from today is not nearly the same as what the potential drop could be for just an exhale or even noise, but much less an exhale, right? So, can we get a 10% drop for a rally that would equal the noise, right? The level of noise that we can get just to come down to this 23%? I don't think so, right? I think that from a Bollinger Band perspective, especially on a IWM, when you look at it on a long-term basis here, let's just go like 5 years. I mean, that's how, because we've rallied so far off of that third, when we broke up post-election, broke up to new highs, we've rallied so far and so fast on very little volume. There is literally nothing holding us up going forward, right? I mean, let me get rid of that expiring cone. It kind of throws off the scale. There we go. I mean, look at all the volume. There's not very much volume holding us up down back to this 38% retracement level. I can actually move these up here so we can get a better picture. But there we go. I mean, that all the way down into here, this 38% level, or this 62% retracement of the current intermediate run that we're on. So let me update this one too. Again, that's where support will be, and there's nothing really, because of how fast we've moved, keeping us from getting there. All right, so if you take a look at the intraday, so we continue to get new high tags all the way over here on the right. So that Arun indicator I've shown you before is still looking very good from and you can be up here for a while, but we never really did get the green line all the way down. When you get the red line up and the green line down, that's your pullback, right? Obviously, we didn't do that for SPY. We did on the NASDAQ. So we got the red line all the way up to the top, way over here when the pullback started. The green line eventually got down to the bottom, way down here. And now we're kind of stuck in the middle, right? Trying to figure out whether or not we're going to get up and get going again. That high tag is going to start moving. So you can see here, the high tag has got a few, another day. It's going to be up here for another couple of days. And then it's going to drop down to this day, this one over here for another day. So it's going to stay, the high tag the green line is going to stay at 0 for a few days, before it comes over here and stays over here for a while. So unless we get a new high tag, it's going to stay at this point, which looks like 324.33. 324.33. I don't think we got to that point. That was 324.20, and this is obviously lower than that. So that's going to be our new high tag, here. And it will be 1, 2, 3, 4, 5, 6, 7, 8, 9, 9 more days, unless we push up beyond yesterday's high tomorrow, right, and get up there and keep going. Looks like we're kind of flirting with our closing price right now in the after hours. You can see the move. We gapped up yesterday. We filled in that gap. We gapped down today. We filled in that gap. We fill in gaps, right? Common gaps get filled in. That common gap got filled in. This one got filled in. This one still hasn't been filled in. And I still, there wasn't a surge in volume. There wasn't any indications that this was not a common gap back here on the Qs. That would be a gap that starts a new intermediate run. So if you look at it from this perspective right here, and you say, okay, did we have a significant gap to the upside? That would be on March the 9th of 2000. So let's see, where was that? What would that look like here? It would be, let me just go make sure what day that was on the gap. So it would be March the 9th. Yeah, so that's the day that we did get. And this is, the scale's going to be changing as we get these days off, these crazy days we had in March off the table here. But you can see, we did have a 2 standard deviation gap with a 3% move. So it very well could be a runaway gap to the upside. The issue again is, unfortunately, is that we didn't see enough of a drop in some of these other areas to say that we actually had a pullback to where we could get a runaway gap to start us on a new bullish run. But that's the issue, whether it's SPY or whether it's IWM. We still haven't gotten to that point yet. Another interesting chart that Andrew Thrasher shared on volatility, and I wanted to bring this up here. This is the volatility, the Arun indicator on the volatility index for the full year. So the 52-week low for the VIX is today, so it's at 100. If you over here look at these numbers over here, the 52-week low was today, and it was yesterday too. But the difference between yesterday and today is the 52-week high for volatility was the very far left of the chart. So when you look at a 1-year chart, There's your 52-week high, and then there's your 52-week low. So, if you go to previous examples of this condition, when you have the red line getting all the way up to the top and the blue and the green line getting all the way to the bottom, even if it's eventually, you can see it generally leads to a period of increased inflation, right, or volatility. So back over here, when we hit this level, is actually going into this August expiration when we finally got closer to zero, with the red line up still high. By the time we hit 11 and a third, within a couple expiration cycles, we had hit up to 22 and a half. So the volatility index basically doubled, right? That would be the equivalent of getting basically to 40 right now. So it doesn't seem like a big move, but again, you can see how significant that would be. That's here in 2016. We also had it happen here in 2014. The high got up. High got up here to 100. Eventually the low got to 0 over here. So going into June expiration. And interestingly enough, now we're going into March expiration. So it appears this happens going into expirations. And again, we ended up closing here at about 10 and a half. And within an expiration and a half, we were up to 17. And within a couple more expirations, we were up in the mid-20s. I mean, that's more than doubling, the volatility move higher from that particular point. All right, so you can see lots of examples of volatility falling down to low levels over here. This is 2011. We finally got down to where the top peaked. The negative index peaked up here at 0. The top index over here finally bottomed out at 0 as well. The green line got down to 0 within a little bit, and you can see going into the end of the year here, we had a rise in volatility going into that August expiration. We had a rise of volatility, and also pretty much there in September, but from about 13 and a half all the way up to 23 within a few expiration cycles. So these aren't like these aren't drops in volatility that really kind of blow us out of the markets. There's another one going into that jump in 2011. And you can see over here the move higher when we got these lows as well. So, again, this pattern of getting the low point, the 52-week low on the current day with the 52-week high on the 300 or the 252nd day, which is a year away, is pretty bullish for volatility, especially when you combine it with the idea that we're flirting with 20, which is a significant low that a lot of people are watching. So that usually leads to fake outs when a lot of people are watching for a breakout of a certain area, leads to fake outs. And then you have this extreme low on, at this 80% level. Again, to kind of give you an idea of what that looks like. We're not, the week's not over with, but you can see when you get down to 80%, we typically get moves higher off of these extreme lows, unless we stay down for a long time like we did in 2017. But again, in 2017, the reason why we stayed down there for so long is because the VIX was well below 15. We were flirting with 10, but that's not the case right now. We're actually still, up at relatively high levels and just barely flirting with dropping below 20. All right, so to summarize our technical outlook, as I said before, there's a lot of risk that's out there right now. It doesn't mean that we're going to go down tomorrow. It doesn't mean that we're going to tank when we do go down. On a long-term level, I expect any exhale we get to be nothing but noise on a long-term basis. I still think on a long-term basis we have a lot of upside potential because I think the dollar is going to be dropping and we're going to be moving into international equities and commodities. So there's still a lot of bullishness left, and I don't think the run on these large cap tech names are done. But in the meantime, are we set up for an exhale? Are you prepared for like a 20% drop on the Russell, like it would be nothing, right? If you're not, if that would be too much, then that means we have too much at risk. Right, because that would be the equivalent of like a 10% drop to 15% drop on the S&P. Can you handle that right now? While still being bullish, because that's the trend we're in. Can you still make bullish trades now, but handle a 10 to 15% drop like it's nothing? If you can, then great. You're properly, you're managing your risk okay, and you're taking advantage of the market environment. If you can't, then that means that we've got too much at risk, right? And that's what I keep. That's what we talk about all the time in my classes. And you can see an example of how to trade with the trend, but still manage your risk with what we are doing in our class portfolios. But in the meantime, I think we're getting a lot closer to that exhale type because of how extreme the bullishness is. Like again, it doesn't mean it will happen tomorrow, but the downside risk compared to the upside return is getting very skewed to the risk side. I don't know when it's going to turn. I don't know when the exhale will start, but the risk to the downside compared to the return to the upside from today going forward is getting very skewed. When you're at a low point, then you got a lot of return potential with very little risk because you've already had an exhale, right? But when you've gone up so much, now from today going forward, how much more can we go up? That move is little compared to how much we can drop, and within an exhale, right? Within just a Fibonacci retracement, it's getting skewed. It used to be big to little when we were coming up off a low, and now it's reverse. So that's what we need to manage. What do you think? Do you agree with that? Do you disagree? Let me know in the comments section below, especially if you disagree. What charts or indicators are you looking at that might suggest that should we already have had our correction and here we go back up the truck? Or maybe you think it's going to be more than just noise, right? It's going to be more than just an exhale. I don't think that's going to be the case. But if you do, and if there's something that's telling you that, obviously there's a lot of people who think the market's going to crash all the time. But if you've got something that you're kind of watching that suggests, man, this is going to be worse than 2008, then share with us in the comment section below what you're looking at. All right, so now let's take a look at what's driving the price action. Obviously, we all know what drove the price action today. It was a Fed statement. Let's take a look, and not the sectors, let's do the asset class first, and just take a look at how things look like going into and then how they look like coming out of. So we'll just look at today alone. So there's our move going into. The dollar was bullish and everything was down. And the Qs were down, the emerging markets were down, bonds were down, which means bond yields were up. I think the market was kind of expecting the Fed to say, hey, there's every potential that we could raise interest rates. But that changed dramatically, right? So there was an initial drop in bonds, but bonds rallied coming off of those lows. The dollar fell like a rock. Here the gold rallied with that drop in the dollar. Gold rallied, not a risk-off move, but just an anti-dollar move essentially. And then stocks rallied, especially international stocks. Emerging markets lagging behind. They kind of pulled back at the end. They had a surge. But Qs rallied, small cap stocks rallied, Qs pulled back too, so small cap stocks finished stronger, but everything rallied there. And commodities were really bearish, and then they rallied towards the end of the day. Because basically the Fed says, hey, we're going to let inflation run, right? We're not anywhere close. Now, take that for what it's worth, because when you look at Fed expectations, I haven't looked at this chart in months, but we're finally starting to get Fed rate hike expectations here. And you can see they're rising today for a rate hike by the end of the year. Now, they said today that most likely it's not going to occur potentially to 2023 on a median basis. But the reality is they never raise rates when they originally forecast. They always start to bring the forecast in towards, right? This will change, right? These probabilities, these probabilities here for December won't stay down here. They'll move, right? They've always have, and they will. They'll move. And so the market will bring, we talked about this quite a bit today in our trading room, the bond markets will bring the Fed into the decision rather than the other way around. So the bond market made the Fed raise rates last time, right? After this big QE surge created a big yield spread in 2013 going into 14. And then finally by the end of 15, you had your rate hike. So that happened before last time, a very similar environment now. The bond market produced the mid-cycle adjustment that the Fed cut rates in 2019 because the 10-year note was dropping so far, had dropped down to an inverted yield curve, which is rare for the yields to drop to an inverted yield curve. Usually the Fed raises rates and raises things up to an inverted yield curve. So that's going to change, but it's interesting to see that it's starting to slowly ramp up. It's very, very low probability, but I fully expect this number to not be 6.5% for very long, right? We're gonna keep a close eye on this to see if and when we will get a Fed hike by the end of this year. You can see here that the relative strength had a pretty relatively bearish day, but finished up above the 8-day moving average after being so far below it. So the Qs are trying to get going here on a relative basis. We'll kind of keep our eyes on that again. When this changes, more than likely it will change because of a broader risk off move, and reconcile this extreme bullishness that we've had in small caps. So we'll keep our eyes closely peeled to that one. But that's what we're seeing. Let's take a look at some of the major asset classes. Like I showed you the Euro US dollar, and it's rallied back up here. So the dollar has fallen back up to this level. Again, major inflection point. We either break through or we hold it, kind of like where we're at in the NASDAQ. If you take a look at gold, which has been so bearish, it's been trying to bounce back up. It's found support at that 62% Fibonacci retracement level. So this would be the COVID low point, the rally. We've found support there, and now we're just continuing to come up. Again, I don't expect gold to have this significant move, but while the dollar is bearish, look for gold to make a run back up to this 1850 area at least. Before it finds another area of resistance. And then the yields have just been going up crazy, and they continue to go up. There's the 38% retracement level of this kind of longer term move here. So when yields really started to fall, and the bear market, this fake bear market started in the fall of 2018, and yields really dropped from there to there, you can see we're back up to that 38% Fibonacci retracement. And I feel like we'll probably get some kind of resistance up in this area before pulling back down towards the 38% and that 23% line. Just briefly, right? I don't expect anything too major, but we've had a significant run on yield to get the golden cross, and a lot of times that produces a return move back at least to the 50-day moving average, if not down to the 200-day moving average, and get you an idea again of how fast this particular run has been for the 10-year yield on a positive basis here. If I go back, you can see it's 100 percentile in the last 5 years. But if I go back to the last 20 years, it is the highest and fastest move in this short term, or relatively short term. That's the fastest run on yields that we've seen in the last 20 years. Right now, it's coming off of the biggest drop that we've seen in the last 20 years, and we're kind of basically oscillating here. But that just goes to show just how significant this run is. And again, going back as far as we can to 97, that's a significant move. Now, the lower the yields get, the bigger the moves will be, and that's the nature of the beast. So that's why we had such a big drop here, because we started off the drop at lower levels, right? We didn't start off the drop up here. We started off down at less than 2%. And so that's how bond yields work, right? The bigger moves occur when you're at lower levels. So we're getting a bigger move to the upside. But just to kind of give you an idea, after we get these big moves, this is the kind of move that I expect that we'll get right now. Just a kind of an exhale, golden cross, exhale, pull back to the 200-day, however long it takes for that to happen, and then a continuation of the rally. I expect we'll probably get back up to this 2.5%. If not up closer to 3 by the time this long-term golden cross environment is done. Now let's look at the sector moves, and you can see again how they performed pre-FOMC and post-FOMC. And you can see here that initially going into it, it was small cap sectors, right? The technology was down, communication services was down, industrials was up, energy was up, materials, financials, all. I mean, it was like the opposite of yesterday. That's kind of what I tweeted out early for those who follow me on Twitter. Here, let me pull this over so you can see it. I tweeted this out yesterday, this one. Despite the bounce back from yesterday's rotation back into the technology names, a lot of people talking about, okay, here we go again. No, the reality is there's our rotation right now coming out of these energy, financials, industrials, materials sectors, and look at what's going up with the most momentum, going into relative strength territory. That's utilities, staples, and real estate. Those are your safe haven areas. So yes, we're getting a little bit of technology and a little bit of communication service and a little bit of discretionary, but the reality is those three don't have a whole lot of momentum or relative strength. like the safe haven areas do. So keep that in mind when you're looking at a day-to-day move. But once we were done, by the end of the day, discretionary took off like a rocket. Industrials and materials and energy really did well. Financials, they held up, but technology, communication services really rallying. And look at utilities, which have been pretty bullish lately, dropping like a rock. In fact, if you go out like a couple of weeks here, utilities had been a pretty decent mover to the upside. Utilities and real estate, with energy dropping off, they've held up and had a really good run off of, I guess it would be the 3.5 is where I need to go to. Right, they've been doing very, very well here along with discretionary. So utilities pulling back because of the yield situation. Look at energy. Energy had been pulling back too during this little rally that we've had, 5.5% rally off that March 5th low point there. The end of the correction. I guess you can't see me doing the air quotes around that correction. All right, so for our trade idea of the day, let's take a look at Occidental. Occidental giving us a little bit of a bullish engulfing pattern here, coming off of support at the 38% Fibonacci retracement of this little rally we've had. I mean, again, not an intermediate pullback here either. No dark pink shading and red line. But this last leg higher that we've had, this current leg that we've had on this current intermediate run, that's brought the market sentiment line down. The near-term lines had some bearish highs. So a little bit of a support level there. You can see on the 17-day moving average, we had pulled back down below the 17. We bounced back above it today. We're not back above the 8-day yet, or above that 23% retracement yet, but looking pretty good, right? Looking, especially when you look at like the Bollinger Bands here, coming down towards us, a little bit of a bump in support and volume at this area. You can see it here on the 4 weeks too. Right, there's the point of control where we had hit on the 4-week chart. We get above this last little level, 29.5 roughly, and we can kind of get going again. Not for a very long period. You can see the ADX for Occidental, like we've been so bullish for a while, it's been dropping. So I expect that we'll start to kind of slow down the bullishness to the upside as the ADX drops. The Bollinger Bandwidth, as you saw here, also kind of driving down to the low side. The trend strength indicator not showing, that it has been strongly bullish, but well up above the cloud and hitting that blue line and bouncing. So it's hard to maintain a significant strength like that when you're this far above the cloud. But again, I don't have to, like if I do a bull put spread on this, I don't have to have it go up too much. I can just sell here at the 27 delta, buy the 25 delta. Or sell the 27 strike, buy the 25. That sets me up for a bull put spread for April expiration. We can get rid of this one now. It looks like we got, about, 60 cents out of that. So for roughly $1,000 of risk, which is our normal risk for a trade, because I don't have to worry about earnings here. We've already had it, getting well over the 30% return on my risk. And then you can see where my break even would be. We'd have to be breaking through Fibonacci support and breaking through that 50% retracement level of this current run. At that point, we wouldn't be on a bullish trend anymore. We'd be well below the blue line, and we'd be flirting with, by April expiration, we'd be in the cloud if that were to be the case. So we'd want to be out of it by then if we get to that point. So there's our trade idea for today. All right, so that wraps us up for today. You've heard from me now, and now I want to hear from you. Use that link popping out in the top right corner of your screen. That takes you to our Market Outlook forum, where you can post any new threads, reply to anybody else's thread, and be able to interact with our market scholars community there, with any other Market Outlook viewers as well. And let's keep this conversation going again. As always, thank you very much for watching. Remember, you can subscribe to our YouTube channel on YouTube there. Hit that thumbs up icon as well, and comment on our video. Remember to like us on Twitter and Facebook too. Have a great rest of your Wednesday night, everybody. Again, remember, no video tomorrow with Brandon being out of town, but I'll be back on Friday. Have a great one. We'll see you all next time.